Today's show is brought to you by Wealthbox. This week's episode is sponsored by the #1 rated CRM software for financial advisors. If you're using Redtail, Salesforce, or any other clunky CRM, go check out Wealthbox at wealthbox.com. Tens of thousands of advisors have switched to Wealthbox, and it's super easy to do. Register for Wealthbox's AI Wealth Tech Week, an upcoming week of daily webinars featuring Wealthbox's AI integrated partners like Jump, Levitate, Zox, WealthFeed, and more. See how CRM and AI can help you as an advisor build and manage your business like never before. Register for AI Wealth Tech Week at wealthbox.com/AI. That's wealthbox.com/AI. Ladies and gentlemen, welcome back to The Unlock. My name is Downtown Josh Brown. I am here with my co-host, as always, Mr. Michael Batnick. Michael, say hello to the folks.
Hello, hello.
We have a very special guest today. His name is Jason Pereira. He is a wealth tech expert. He's also a podcaster. He is someone who I look to as one of the leading experts on how advisors are spending their tech budgets. What are the new emerging trends? How to build an excellent advisor tech stack. We're going to try to get to as many important ideas about financial advisor tech as we possibly can. So thank you so much for tuning in. Jason, welcome to New York. How are you, sir?
Thank you, sir. It's an honor.
It's an wow. I don't know, an honor. So before we even get started, give us like I'll do your official bio, but I want to hear it from you.
Go for it.
We know you're a financial planner, tech consultant, writer, podcaster. What's your background in the industry? When did you start, and where are you at now?
So funny enough, I started back in high school when I realized that I didn't want to go to university and take a degree I was never going to use. So I need to figure out what I want to do with my life.
You like Doogie Howser? You give
nerd
financial
alert.
advice in 10th grade?
So no, but I went to like I don't know what they call it down here, co-op department, where they place you for a job, right? And I basically said, they're like, what are you interested in? I'm like, well, I'm a young boy. So like, of course I like money. I like this, I like whatever. I get placed down at one of the largest broker dealers in the country, working for one of the largest brokers in the country. And that job went from filing to data entry to basically just whatever extra jobs they had, and went from a 4-month term to come back for the summer, to come back whenever you have time off, to like all through undergrad, and then basically
And they
having a
probably
job.
gave you all the tech stuff because you were the kid.
Well, I knew how to use the computer, right?
That's right.
So that was it, right? So yeah, and that was an interesting experience because I got to see a bunch of blowups. I got to see the Briac scandal, if you guys remember that one, Nortel collapse, all the great Canadian catastrophes, as well as, I was there during WorldCom and all the big catastrophes of the end of the dot-com bubble. Yeah. But I left that world despising it, quite honestly. I saw the potential for helping clients, but it was a large Canadian bank broker dealer who could care less about anything other than like profit. I always say there was no metric for client success. So that's when I left, joined an independent, did that for a couple of years, and finally left and started my own thing, and with my business partner, and we've been going ever since.
So you have your own independent financial advisory firm based out of Toronto.
Yep.
And in addition to that, like us, you're a big content creator. You do a lot of, I think you do a lot of really great technology interviews, people that are selling software to the industry.
Yeah. So so that came out of the fact that when the fintech scene started to basically pick up, I would reach out to a bunch of companies and be like, hey, I love what you're doing. Is there like an advisor version of this? And they'd be like, hold on a sec. You're an advisor. You know how to use a computer. You're under the age of 50. Like, who are you?
Yeah, it's so interesting.
So exactly.
Because it's really not until the last 10 years that financial advisors started to think of themselves as technology buying entrepreneurs. That's really what it is now. So that's what the industry.
I mean, we started with Orion in 2014, and I remember uploading the data and saying, "Holy shit! Like you can't leave. What a great business this is.
Yep.
You're married."
And then they knew that.
Yeah.
They love the lock.
Now you just can't leave.
Exactly. They make it painful.
All right. So here's where I want to start, Jason. Are financial advisors better off today in a world of infinite wealth tech choice, which I would argue that's where we are?
Yeah.
Or were things easier and therefore better for the average advisor 10 years ago, when it was basically 3 decisions? Pick a custodian to hold your client assets, pick a portfolio accounting solution to report returns, and then pick a CRM to manage your customer service. And then you were done.
Yeah.
And now there's maybe, 30 companies in a typical advisor's tech stack. When were we happier as a profession?
So maybe you were happier previously, but you were
I
also
think you know what my
unhappy.
answer is,
I know what
right?
your answer is, but
Okay.
here's the thing. You were happier, but you were also unhappy because all of that stuff didn't do what you wanted it to do, right? So yes, it was simpler. Was it better? No. The infinite optionality does create complexity, and our need to basically be like, oh, I want to buy this kind of software. Crap, I got to go through 12 different vendors. Like that is a massive pain. But you have better odds of finding the thing that best fits your offering, your philosophy, your belief, what you want to do for clients. And that's what matters, is what is it you're trying, the value proposition you're giving to clients that is better supported today than it ever was previously. Now, back to your point about you had three options, three things you needed. Guess what? You can still run a business that way. You can still run a very bare bones business with only 3 or 4 pieces of software.
Can you compete though? Because there are some firms trying to do that.
Yeah.
There are some firms saying, look, man, the custodian is providing me with a lot of this stuff. It may not be the A-level version of it, but my clients don't know the difference and it's good enough. That's one. Two, every time I don't add a piece of technology, I don't notice any difference to overall customers. So like, I guess you can do it, but then can you compete with the firms that are arming themselves to the teeth?
So let's define compete and where you're competing. Competing mass market, absolutely not. You have a deeply defined niche where you're back to the client, you're providing very deep value propositions to someone who basically has a specific need. I'll pick on some of the ones I've seen before on like the Kitces podcast where, there was one guy who was like basically selling, providing. He targeted clients who were dentists within a tri-state area that were looking to sell the PE inside of the next 5 years. Talk about a specific niche, right? He can pick a couple.
I love those.
Software,
I love those stories. Like the guys like, I only work with bowling alley owners who are north of Duluth.
Yeah.
Oh, it's
Champion
great
fishermen. That was the craziest one.
Yeah, I remember that one.
That was great.
But if that's your route, and I would argue those are very successful small businesses, if that's your route, you're right. You have such a deep expertise in the needs of those people that they are satisfied and not asking you
100%.
about like your stack.
Yeah.
That's not what's important to them. What's important to them is that you know what they need.
Exactly.
Okay, I agree with that. Let's say you're not that niche and you're like, we're an RIA, we're $1 billion, we want to go to $5 billion. And we will do business with anyone with money.
Well, that's the thing. Anyone with
You're
money.
going to need tech.
Then you got to check every box, right?
Yeah,
you got to be like, okay, so, why don't you have an app, right? You have to answer those questions. Can I not consolidate my spending onto your portal, right? Like those type of things that they see elsewhere start becoming table stakes for what it is that you need to do. So yeah, when you are trying to scale beyond, like, let's just call it I've seen individual guys have $1 billion, but when you're trying to scale a business into the multi-billion-dollar stage, no, you have to start checking all the boxes, and that does become difficult. But again, you do have options you did not have before. Now, the problem is they don't play together that nicely, right? The integration piece of this, the client experience where we get all these little things and bring them together, that's the painful part, right? You have to decide on, right now, at least on one of a handful of portal systems, and every time you do, you're giving up functionality somewhere else. So maybe you're using the financial planning software portal or the portfolio management portal as your primary experience. Right, you have that, but you've lost all the deep functionality and extra benefit of these other softwares that you also have.
It is a Rubik's Cube. Like
really
if you get one side orange, just don't turn the cube around because it's going to be a mess.
I love that.
But then but there's two versions of this issue. Number one is for all of these pieces of wealth tech to work in the context of a scaled advisory firm, they need to talk to each other to some extent. Some of them do. But then they also need to talk to the custodian where the actual money is.
Yep.
And you could have breakages in both.
Totally.
You could have the custodian say, oh, we made an API change and it affects these 30 things that people are using, but we had to.
Yep.
And then it's like, well, I just standardized on this. My clients all built logins for this.
Yep.
That's the Rubik's Cube-esque futility.
Yeah, it's like you're like trying to
software.
connect a puzzle with a Lego.
Well, that's the problem, is that most of these things are point solutions. So you may have 5 different softwares and they're all communicating to each other. And if one of them breaks, everything breaks down the chain. However, this is where firms at scale basically get into managing their own data lakes and taking stewardship and custody of that and saying, okay, forget all of you guys and what you're doing and you're providing data. I'm going to take that data feed and I'm going to house it myself. And then I'm going to point it out to where I wanted to point it out. And then, things can still break.
Larger RIAs are housing their own data?
They are.
That sounds like a really big risk.
Look, it's a really big task, is what I want to say.
Well,
it's a big task in terms of the risk. I mean, at the end of the day, you're still taking that data from the provider, right? And you're putting it into a secure enclave. So the risk is more so that now you're taking stewardship and making sure that that connection, that source of truth that's coming in is clean. And that's not a small task.
But you also then need your own in-house people that can keep up with all the API connections.
So
got that right.
To that point, with like all the people that are monitoring this situation or all the software, in 2018, when Michael Kitces put out his first advisor tech map, there was 29 categories, which felt overwhelming at the time. John, chart on, please. There's 29 categories. With
is this the old one or the new one?
This is
That's the old one for sure.
Believe it or not, it's the old one. So there's 29.
This looks overwhelming.
Yeah, dude.
Just wait.
29 categories, 133 companies. So, okay, 4 companies per category. Sort of manageable. Now, next one, we have 36 categories. There's 485 companies. There's 13.
I blame 0% interest rate.
There's 13.
How else does this happen?
It happens because
this is free money for 6 years.
How did we get here?
So I think we got here in a couple ways, okay? So first off, you have to be on here. So before there was companies that weren't on here, but now Michael's basically built like a source of truth in the industry.
The billboard of the industry.
It's the billboard of
the
industry.
You got to be there.
And I joked around with him the other day that basically at the rate of expansion, this thing's going to be filling a full like blueprint sheet in no time,
he's
right?
going to have to be. Yeah. The next step after this is going to be 2 sheets. Or 3 sheets.
Totally.
You can't have a one-page map anymore.
So here's how we got here. A couple of things. First off, the industry has matured. The needs of the industry have matured. So you go back, and what you're going to find is that most of what you have, there's more base level infrastructure, CRM, portfolio management, all the core stuff. Look at specialized planning, right? That first column, second category. Look how big that is. We have everything from how do I basically pay off student debt to how do I understand what's going on in my tax return.
I'm making a random one. Cash management, there's half a dozen in there.
That's it, right? So the reality is that like this industry continues to evolve away from the commoditized like access to markets, we start going deeper and deeper into specific needs and niches of our clients in planning, right? And by doing that, these companies have said, you know what? We can provide value for you on this one specific thing. And if you're someone who basically has this value proposition around things like basically, estate planning, you got the likes of Wealth.com and like 5 other competitors who basically will help you not only develop a will and power of attorney, but keep it up to date. So we've gone further and further down the value proposition chain. And the software providers have provided us with the ability to do that. So that's one of the things. We've gone from more broad to more specific needs. And this is actually how most software works, right? You think about Salesforce is a great example. Salesforce built a giant CRM platform and kept on expanding out and became a giant data platform. But they've also developed sub-niche lines of business in order to target specific industries, right? They got financial services cloud for financial services. They've got a marketing cloud for anyone in marketing departments. Because once you go broad and meet those needs, if you want to continue to grow and expand, you need new
verticals.
You have to go narrow.
John, can you put that chart back up? Just eyeball this. What percentage of these companies are not really companies, but they're just an app that should be on another company's platform? Is it 2/3?
Good question. So, I mean, like, I want to say I'll be a little bit more generous and say a quarter are single functionality.
That's not disrespectful. Yeah. Every one of these wants to be acquired.
Totally.
That's the exit. None of them are coming public.
100%. Well, okay. I think that a lot of them won't be acquired. I think a lot of them will be cottage businesses that provide a good living.
Fine, but we agree there's one way out.
The one way out is to sell. Yeah,
well, so a lot of these are not investable. They could be decent small businesses.
Some of these are basically zombie companies.
But if
right?
you're venture backed, you can't call the venture fund and say, you know what I decided? This is going to be a nice little cottage industry. I'm going to run this for 25 years.
No.
That's not how that works.
No. So, I mean, look, here's the thing. We'll get to the venture stuff in a second. So, look, one of the things that's deceptive here is if we actually did a heat map where the bigger company, if this was based on revenue and you made the logos based on revenue larger, you'd see that there was a handful of big logos.
Oh,
and everything would be tiny.
I would love to see this by revenue.
Yeah, 10 big bubbles and everybody else's.
Exactly, right? So look, there's a lot of startups here that haven't proven themselves. There's a lot of small, older cottage business industries. And then the other thing we haven't talked about that basically is one of the reasons why this is expanding so much is that look at the main infrastructure providers in this industry. They're all legacy. They're all clunky old systems, and people are seeing the opportunity to potentially come in and try to eat their lunch because you know what? You're doing this broad thing. You're doing it very clunky. We can come in with something more modern, sleek, faster, develop quicker, and actually meet the needs of people in a better, faster way. Now we can't do it as broadly, but
who's the best example of that? Would that be like an Altruist?
I think Altruist is actually the perfect example of that.
So Altruist comes along and says, you know what? We're going to do this better. We have better tech. We're going to invest more in tech, and we have no tech debt.
I love that phrase.
We haven't built all this shit that we now have to continue to justify. So we can use modern infrastructure and rails and build something that's really light, really efficient. And then the answer back is, okay, but you're altruist, you're not Schwab, nobody knows you, nobody trusts you,
Yep.
the clients don't feel comfortable. No problem, we'll start with smaller advisors. That takes place for 5-6 years.
Yeah.
And then all of a sudden, mid-size advisors are like, why does my shit not work and your shit works so great?
Yep.
And so that's Clay Christensen,
Exactly.
classic
Classic
disruption from the accounts nobody wants.
Yep.
All the way up until
Yep.
it's like, oh, wait a minute, these guys are coming.
You want to look at the custody world? Look at who is targeting the smaller RIAs right now. Because if they can make something profitable and valuable to those people.
So that's Altruist, Apex. Who else?
Betterment.
Betterment.
Yeah.
Okay.
So you have them. So they can build something sleek and simple that makes the life of the independent solo advisor who doesn't have all this time and administrative staff to support them, make it quick, right? They do that. Then what's going to happen is as they continue to bring in revenue from those people, they will continue to slowly add to their value proposition where suddenly larger and larger firms start to basically want them. And this is, again, like you said, Clayton Christensen, this is exactly the model. Take advantage of what people consider to be the small, unprofitable advantage area of the market, make that work, and then scale up.
What's the resistance from a mid to a large firm to give Altruist or a platform like that a chance?
I think a lot of these firms no one wants to be the first one, right? They want to see someone else of their size and their scale pull off a seamless move over because frankly, there's just too much pain.
Well, it's also just easier. All of our clients.
You can't guinea pig your clients.
No.
All of our clients are at Schwab or Fidelity.
There you go. Right? It's just easier, right? Because it's been there. And those are names that people know, right? Does the average person off the street know Altruist?
Can I give you an answer that I think is obvious, but nobody says it? If Altruist were a publicly traded company, I think they would be like 20% of the market cap of 20% of the AUM in the industry. The fact that they're not publicly traded and their financials are not out there publicly is probably the number one reason why firms are like, okay, your tech is cool, and I'm more comfortable with less good tech, but more reliability, dependability. This company's filing quarterly reports with the SEC. Yeah. I'm good with that.
Look, no one gets fired for hiring Microsoft, right? And what is Microsoft best in class at anything other than Excel? I mean,
and we're a conservative industry to begin with.
Exactly.
People that go into financial planning are not people who are adventurous with technology products.
No. I mean, no one gets the reward for blowing up, for trying and blowing up, right? They get blamed, right? No one wants to lose clients over that sort of thing. So they want someone else to come in there and do it. And you see this behavior in large corporations all the time. And I've seen this in my home country where effectively like Bank A approves software B, right? And that process took 3 years to get through due diligence. And now they're being onboarded. And the second that bank puts out a press release that they partner with that, suddenly all the negotiations with every other bank skip 12 steps. And it's like, oh, you were good enough for them. You vetted them. Right. They're working with you and they haven't blown this up. That's so much they've gone public. Guess what? We can probably do the same thing now.
So it's like penguins pushing each other slowly into the water. One penguin goes in, and then the rest and doesn't get killed by a sea lion.
Oh, it's safe now.
The rest of them jump a seal. The rest of them jump in.
So as advisors build and scale their tech stack, how do they do it? I just mentioned there's 485 companies on this map.
Yeah.
At what point does somebody hire a CTO in-house versus maybe using some industry consultants?
Ooh, yeah. I mean, the reality is that takes scale. That takes scale. I mean, like you got to look.
So the average advisor, how do they do this?
The average advisor is never going to do that. That's the reality of it, right? So like, let's define average.
I think they default to word of mouth.
They default to word of mouth. They go to conferences. They see value propositions. They don't investigate all 40 names.
You can't,
right? Or if they do, they go to the websites of all of them and they look at what they read a couple of things and they make a short list and then they basically do a demo with 3 or 4 and then decide from there. But yes, then they also absolutely will ask around to everyone in their peer group of what are you using?
Well, that's what conferences are for.
That's it.
Conferences, and these decisions right. So these decisions are being made at the bar.
Yeah.
And how much are you spending? Well, back in the day when we had 11 choices or whatever it was, it was whatever, single mid-digit basis points. And now it's a lot more.
It is. You listen to Bruckenstein and he basically says like, scaling companies are spending up as much as 10% of the revenue, getting like the big systems done, and then maintaining closer to 5. But I've seen data pushing that number closer to 3. Right? Look, it's definitely. I think we got to look at it differently because there's definitely like a base level need of technology that you have to spend a reasonable amount of money on. But then. And there's definitely a cost benefit to all that. Like you need it, full stop, right? So how do you do it affordably? But then you look at a lot of the stuff on that map, and it's value proposition based. So the question becomes, if I'm taking on this marketing software, what's the ROI on that? Am I going to be able to bring in like enough people within a reasonable amount of time to justify the cost of this on an annual basis, right? And for most of them, it's not that big a deal. Like you can bring in 2-3 clients with a piece of marketing tech if you use it, and that more than justifies the cost. Great. Then it becomes things like, for example, the estate planning softwares. How many more clients am I going to win by basically bringing this on? And again, back to word of mouth. What is the number one source of new business for advisors that's been struggling and diminishing for years? It's been referrals, right? Now, why is it diminishing for years? Well, there's lots of reasons, but I think one of the fundamental reasons is that everybody looks the same, right? How do they differentiate between, hey, I like my guy. Well, yeah, I'm not happy with my guy, but what does your guy do? And pardon the term guy, woman, whatever it else is. But the point is that to say like, well, here's what my person did, X, Y, Z, blah, blah, blah. Oh my goodness, my guy never did that, right? So those points of differentiation will absolutely help with the referral market and client satisfaction.
What area, by the way, let's put up this chart of just the growth of the Michael Kitces map. So ChartKid Map made this for us. This is the growth in the number of categories, and that's dark blue, and the growth in the number of companies.
So I think what's going on
here.
here.
This is not 20 years apart.
No.
This is a really important point.
What's going on here is obviously a lot of money came into the industry. These are software margins. We know what happened. We know what happened with software multiples. So talk about this push and pull of the people that are funding these experiments, these companies, versus the people that these companies are ultimately serving, which is us and our clients.
Yeah. So first and foremost, you look at these companies. You ask them, who's the money, right? I think when the money's not VC backed, right? When it's internal or it's basically friends and family, whatever else it is, and you have a founder who's passionate, I think you get much better product.
Absolutely.
You get stuff that's purposeful.
There should be an advisor somewhere involved.
Yes,
like
a
user.
100%.
Right.
Like if you don't understand the problem deeply, how are you going to solve the problem in a deep and meaningful way, right? The entire number of times I've been pitched by companies like, well, we're from outside the industry and we think we can solve this problem. And I'm sitting there just face palming myself. Have you defined the problem first and foremost? Like I've been pitched so many AI tech solutions. We're like, oh, we're going to plug into your existing workflows.
To do what?
Well, what workflows? Right?
Yeah.
These guys are assuming that these workflows exist, but your workflows, but my workflows are half manual. Like you're assuming that these workflows are all digitized and super streamlined, and all you got to do is hit an API to trigger like 12 different actions. That doesn't exist. And a lot of the workflows that exist in the systems that we have to date, they're mixed workflows. There's like, hey, this thing's happening automatically, but then this creates a task for my assistant to then produce this document. Right?
So I think we would agree that it's much more exciting to find a company that is advisor founded, where the advisor says, I've been in the industry, I can't stand this problem,
I know this pain.
and I can't believe nobody's done this. So I have to do it myself.
100%.
So I would say one of the best founders ever in the history of our space is Eric Clark.
Yeah.
And Eric tells the story of how he created Orion. He was doing portfolio accounting for his dad, who was a standalone independent advisor, I think in Omaha, right?
I believe they're based out there. That's right.
So, right. So he's tasked with literally tabulating the returns of the portfolio and putting them into a document. And he says, this should be automated.
Yeah.
He walks on campus to University of Nebraska to the computer science department. He gets some students and he says, help me build this. Yeah. That is as organic
100%.
as a wealth tech story gets. And the reason it worked is because the person who had the hard problem to solve is the person who solved it. What we have now, and I'm not saying this is everybody, we have people that are like, I just got rich from selling a startup. I talked to Merrill Lynch.
They couldn't do this.
They suck.
Yeah.
I talked to an RIA. They suck too. We should just take over the whole wealth management business. Do you know anything about it?
Yeah, they don't have the tech.
No.
They don't
have
have
like going to a restaurant and being like, this is not a good steak. I'm going to start a restaurant. Oh, are you?
Yeah, exactly. That's exactly what happens, right? And the thing is that you tell an engineer that there's a problem. You ever met an engineer who didn't think there was a problem they couldn't solve?
No.
Right? They all come in like, oh yeah, we can do that. We can. The number of times I've even had a couple conversations with startups who are like, oh no, we can do that. What are you gonna do? I'm like, listen, do me a favor. Show me that working live right now. Oh, we can build it. Listen, guys, seriously, stop with this because you're going to screw yourselves over because you're going to tell all your possible clients that you can do this. And then you're going to start working on the problem. You're going to find that this little superficial problem you thought was here to here is actually this complex web of connectivity and optionality and all these other problems that you never saw. And when you go down that rabbit hole, you're going to realize that you're not going to be able to do half of what you thought you would.
So this is one of my biggest frustrations with the wealth tech industry. It's that it's always, we're building this. And it's over-promising and under-delivering almost every time. And it's like,
Most
listen,
of the time.
come back when it's done.
Yeah.
Come back when it's done. Show it to me when it's ready.
Chicken and egg, though, man. They need the clients to basically work with them, right? So there are firms, and I'll guinea pig anything, but I won't guinea pig it with my clients, right? I will play and I will test it, and I will play with betas nonstop, but it needs to be like bulletproof before I roll it out.
So we had this problem literally this week with one of the service providers that we're talking to. They're asking for a commitment, and we're not giving them a commitment until it's ready. Like come back when it's done.
Yeah. Well, I think it depends on how much time you're willing to spend on it, right?
Well, but I see it from there. Wait, I see it from
Yeah,
their
they have to
side.
justify the expense. I get it.
Let's say they have 20 engineers.
Yeah.
They need to put 3 of those engineers on this specific thing. They don't want to do that if they don't have an agreement that someone's actually going to use it.
But here's the
I understand
thing.
this.
The question is, what's the problem they're trying to solve? Is it specific to Ritholtz, or is it specific to the industry? Because this is the issue. A lot of times these firms will go around looking for someone to sponsor the cost of building something that is a universal solution. That's wrong, okay? If I know that this is a problem that you guys experience, but so does every other RIA out there, that is core to the software. The thinking should be is that this is core to our offering. And yeah, you know what? We need to find the money to dev this for everybody. But to
this
go
is
out
the
and ask
problem.
you to do it is wrong.
I have always said this. I said this to Nick and Anna when they're talking to potential vendors. Like, bend these people to our will. It's going to work out for them.
No,
if
but
they do what we say, every other firm is going to.
but that's not.
That's my opinion.
But I know that's your opinion. A lot of tech people say to us, "If you've seen one RIA, you've seen one RIA."
Yeah, I don't believe that
and
at
the
all.
problem with building for scale, a lot of us we have similar problems, but a lot of us have unique workflows.
You absolutely do. But the question is, so again, is the problem specific to you or is it specific to the industry? If it's specific to the industry, that is something that gets amortized across the entire board. If it's like, guys, respectfully, we deal with 150 RIAs. You're the only ones who've asked us to do that. Look, none of these guys.
That's unreasonable.
Right,
Then
yeah,
that's unreasonable.
yeah.
I agree
Yeah.
with that. But I don't think you could have different workflows. It's a very easy thing, though, for other firms to say, oh, we have to change our workflow to work with this thing that we really need. Okay, we'll change our workflow.
But to Josh's point, now these companies have to justify their spend if we're building something for you.
Correct. But also, I think it also depends on how they've architected it, right? Because if they've architected the more modern way, which is effectively, look, it's more expensive to do this too, is to everything you're building already has an API. The second a function is being created, we create the API and then they're building their software platform over top of their API base, right? Which is historically, it's like I build the software and then I layer on an API base and I got to build these functions on. That's far more complex. So like Conquest Planning has already done this from day one because they've been here. They did Naviplan before and they knew the customization killed them in Naviplan, right? They built everything API out. So now they go to you guys and you guys say like, well, okay, but we need you to do this to basically integrate. It's like, okay, well, we're not going to spend our time doing that, but here's a giant API library that we will work with your people or we'll, do a little bit of custom work for you on it. But we've enabled that level and degree of integration into whatever else you're doing based on the fact that if we can do it internally, we can do it at all, we can give it to you and we can make it work for you however you want, because once it leaves our system and gets in through our API, you can do whatever you want with it, right? So there are ways to basically kind of find a happy median, but it is a more expensive way of developing. That's why a lot of companies don't do it.
You define tech debt. This is a term we used before. This seems to be one of the main reasons some companies are moving quickly and some companies never seem to be able to do anything.
You can ask a bunch of different engineers what technical debt means, and they'll give you different answers, right? A lot of it is that, look, we basically developed on old code, right? So newer coding, newer systems. You have a bunch of companies out there now that developed pre-AWS era, right? So they weren't built native. So that creates there's
pre-cloud.
Exactly, right? So there's a lot of old servicing, old code in there. Or they developed a really good solution for something very narrow, but then they've been asked to layer on functionality over top of it, right? And now this software is being like stretched and the core is being stretched to do things it was never intended to do in the first place, right? And that creates real issues because, hey, if they could go back to square one, right? They would basically have developed something different. They would have said, okay, we're going to build a system that would allow for all the optionality that we needed later on, right? So instead of being able to say, hey, system, do X, Y, Z, because we've developed you to be able to do that, they're saying, hey, here's this new series of other things you got to do. They're jury rigging it. You got to twist and turn and do all kinds of other stuff. The core engine spits out X, but they got to just then take it and reformat and twist it around to get the end result that they need by bringing other stuff into it. So it's far more cumbersome to do that and then maintain that.
This is part of the reason why that map now looks like it looks, because companies come along or founders come along and say, oh, we could run circles around these people. And they are.
Mm-hmm.
The problem is it's really hard to get to scale.
And distribution.
This is the problem, right? So one of the two things is going to happen here. You're starting to see it in certain areas, and you won't see it in all, where basically Clayton Christensen's right. These guys are going to pick up, slowly start to eat the lunch of the bigger players. Because those bigger players, not to pick on Envestnet and Orion, how much broader can they go?
Right.
They
do
literally
everything.
got everything, right? But they got everything cobbled together with legacy software and tons of technical debt. So if these guys slowly start to eat up that value proposition, it's going to take a long time. Option two is you have well-developed systems from outside of the U.S. that basically built for multi-jurisdictional in the first place that can potentially enter the U.S. market as mature products already. Now, the problem there is that you're always going to come into issues in different jurisdictions, right? FNZ is a big player in the banking space. They provide massive platforms that run your entire system. In fact, and wealth management as well. But the reality is that like they work in like 20 countries, something like that. But every time they enter a new place, it can create problems. There's a massive project in Canada right now. It's been going very slow because they underestimated the scale of the thing. So the reality is that once they may be mature, they have the money to spend on it. But if they land and nail that first big client, then now that system can be deployed elsewhere. So there's an opportunity for foreign companies, if they're done with the intention of going internationally, to come in the U.S.
5 years out, as we think about what this heat map is going to look like, or the Kitces Tech Map, is it likely that 485 goes to 700, or that 45 goes down to go down to 300? I think this is late stage stuff.
Yeah, I think some of this is late stage stuff. I think you're going to go through a period of expansion, contraction, and expansion again, right? So what you're going to see is a bunch of consolidation, a bunch of things. So I'll give you an example. The hot buzz thing in the AI space, the simplest use case that we have right now in the space is meeting note taking, right? I got pitched a meeting note taking solution every 2 weeks for the better part of 6 months. Okay, the reality is that there's merit to it and they can solve this problem. There's a bunch of companies already doing a pretty good job of it. But the reality is when you look at what they all do, a lot of them are trying to solve the same problem. Doesn't consolidation of some of these players start to make sense? Instead of these guys competing against each other, shouldn't they be saying like, hey, like we've now all got a little bit of revenue and we're fighting each other all the time.
Well, it depends how much money
they merge.
Depends how much money they raise.
Assuming that, so it depends
But
how much money
that has always happened, and that will definitely continue to happen.
Exactly. So you're going to see it to start to happen with some of these players, I think, right?
Yeah.
And you're going to start to see other companies start to say, you know what, we're a big size player in this space. We're going to be the next Envestnet or Orion. We're going to start to consolidate.
A lot of this stuff is going to be about what the cap table looks like post. So you have founders that raise money.
Yep.
They, of course, understand at a certain point, like, oh, we built this standalone niche piece of software. It's not really a company. It's a feature.
Yep.
But our backers don't want to take $3 a share. They would take stock in the new company we're merging into.
Correct.
So there's going to be like a lot of I think a lot of horse trading in order to get everybody on board that we should probably sell this thing.
The money complicates matters. The number of times I've seen cases where it's like, look, legitimately this company should have sold or merged somewhere else, but the problem is they never get the valuation that's going to justify the previous round.
They're zombies.
They're zombies, right? So they got a couple of choices. They either basically merge or exit on a down round, which really pisses off their money connections, assuming they'll even be allowed to do it if they have enough control. Or like you said, maybe they kind of cut some sort of sweetheart deal for a better growth trajectory elsewhere.
I want to pivot a little bit. One of the things that you hear all the time from wealth tech founders is that they're going to build a product that will appeal equally to wirehouses and RIAs and independent broker-dealers and hybrids. For me, it seems like an almost mythical quest to be able to do that. I think you either are building big enterprise shit for Raymond James and up, right? And then all the way up to like Bank of America, Merrill Lynch. You're either doing that or you're building something for the independent channel that's going to be more self-serve. Advisors are going to find you. They're going to seek it out one by one. And there's opportunity and challenges in both markets. Have you ever seen a company successfully be able to do both?
No, but I think the potential exists, and I know some companies do. No, but here's why.
But it might happen.
So but here's why, right? Because it depends on what value proposition you're defining, right? So if you're looking for what I affectionately term as the one ring solution, like the one software to rule them all, the reality is that there's no way. Those markets are too diverse and too different that you're not going to be able to meet every need of all of them. That's insane, right? Like
insane. Can't be done.
However, if there's one specific niche vertical, I'll pick on financial planning as a possibility, right? And it already happens in financial. Well, so it has happened, right? So eMoney sells to very large wirehouses and down to solo advisors, right?
Okay, so there's a great example.
So there is example, right? So financial planning is probably maybe the one place I've seen it done because the value proposition is uniform and tight enough that the financial planning software can say, we're just going to stay in this lane. We're going to be the best we we can in this lane. And we're going to and that need is universal because the need is the need of the end consumer. And it doesn't matter if you're at a wirehouse or a small RIA, that need doesn't change, right? Like it changes based on the dynamics of the client, right? They build around the client needs.
Oh, that's interesting.
But that's it.
The more client-facing something is,
Correct.
the more potential there is for it to become universally used.
Correct.
If something is more B2B advisor-facing, it's going to have to be much more custom tailored to each type of firm.
Do you think that the tech is more client-facing today than it used to be?
Yes.
A lot of this was just for us, and now it's for the end client.
There's an old saying that, not old saying, there's a old in tech saying that Amazon got us used to instant and Apple got us used to beautiful. And the reality is that a lot of us, I mean, just when we open up software and we see that it's overly engineered and just difficult from a UX standpoint, terrible experience, right? Who wants a terrible experience? I want something that looks pretty, but not just looks pretty. I want, the old Steve Jobs understanding that, look, the UX is not about looking pretty. It's about how I actually interact with the software, right? How it looks, impact, and how I have to navigate everything and how well thought out it is actually impacts my well-being.
If I'm selling wealth tech solutions to advisors, I'm basically making 3 key points. Point number 1 is this is going to make you look more attractive to potential clients.
100%.
Point number 2 is this is going to aid in client retention, existing relationships. This is going to keep people here. And then point number 3, and I don't think any of these are more important than any of the others, this is going to save you money and or time. If you can hit all 3 of those points with an RIA, you can probably close a contract.
100%.
It's really hard to be able to do that, of course. And a lot of solutions come along and they're geeking out on the tech. They're not even answering those questions. And it's like, who the hell taught you how to sell? If you're a financial advisor in America in 2024, you only care about 3 things. Keep my clients happy, get new clients, not spend as much money running the practice. Any other shit that you're focusing on in a sales presentation is going right over people's heads. Why don't they understand this?
I think some do.
Okay.
I think specifically, you're absolutely right. Like that are smaller businesses absolutely get all those 3, right? Because it's a challenge to bring people in, especially when you're not competing on the marketing dollars. You always want to keep the dollars you have today, and you want to find a way to be more efficient. Now let's look at the large enterprise, right? Let's look at the publicly traded wirehouses, right? Here's where, and I advise some companies selling into this, and this is where we beat our heads against the wall sometimes. It's that you go in and you say, look, you already have this large marketing spend. We're not a marketing tool for bringing in new clients, but we are a tool for making your processes more efficient and more cost effective and improving the client experience, which is going to increase retention. Okay. Like that is, and you know what? And yes.
And that will free you up more time to bring in new clients.
Potentially, or it will create at least some level of satisfaction that other people will be able to say, look what I can do, right? And the problem is that you look at publicly traded companies, they're incentivized around 2 things. They're incentivized around revenue growth and bottom line, and growing the bottom line. If you don't hit both of those tones and you don't show them how you can grow the top number and the bottom number, you're just not as interested.
More sales, less expenses.
That's it, right? Unless you say more sales, less expenses simultaneously. If you say less expenses and better experience, but but I still got to hit that top number.
You've made this point that dealing with independent advisory firms, yes, revenue growth is important, but it's not the sort of life or death race that it is if you're a public company reporting to Wall Street.
Quarter by quarter.
So you can actually sell something that, hey, I don't know if this grows your top line, but this will absolutely save you money.
Absolutely.
In operating your practice.
Well, I mean, as an independent business owner, it's
good enough.
You know that what matters is what you bring home, right? And you can do that in one of 2 ways: spend more, save less. Spend more, spend less, save, make more, right? Like those 2 things.
Can we talk AI with the time we have left? Morgan Stanley is, I think, the first of the mega firms to really come out and plant their flag and say, we are doing this and it's working. This is a Wall Street Journal piece from a month ago. Morgan Stanley is using off-the-shelf AI tools like Goldman Sachs is using GitHub Copilot as part of their generative AI coding, but Morgan Stanley is talking about a wealth management usage. So let's say they're the first, right?
Yeah.
Okay. Both of Morgan Stanley's tools were built using OpenAI's GPT model in consultation with OpenAI as part of the strategic partnership the 2 companies signed in early 2022. Morgan Stanley said that after addressing the product landscape for this use case, it opted for customization and seamless integration afforded by building the tools in-house with OpenAI's technology rather than buying fully built solutions off the market. So basically, Sam Altman is talking directly to Morgan Stanley.
Yeah.
This is a Fortune 100 company, I think. This is a crown jewel on Wall Street. If you get the 15,000 financial advisors at Morgan Stanley accustomed to working on OpenAI, effectively, it's a cheat code. You'll eventually get everyone else. Okay, what's your take?
A couple of things.
What are they really doing?
So
summarizing emails?
Same old. So first off, same old approach to everything. Okay. All of these firms have large tech teams think to justify their existence, right? And I've seen this countless times where product is developed and done, and they go in and like, oh no, we can do this. We can do this in-house, because they're trying to save and justify their existence. So one team's trying to bring an outside solution. Another team's saying, no, we need to support our existence so we can build that, right? So this is no different to me, right? If they're already being sent prepackaged solutions that are done and like saying, hey, here's how we could solve this problem.
You're saying regular OpenAI needs no customization. It can work in the Morgan Stanley environment?
No. What I'm saying is that this is the mentality of the people within the actual environment. Like, so for example, meeting note-taking, that's the first one they talked about. I got a very cynical view about this, right? So they developed their own meeting note-taking system, and they basically said this is going to save so much time. And they're right about the math on how much time it's going to save. But, they were probably pitched about, a half a dozen other solutions that were ready for market already.
Do you remember what the math was? They said it's the equivalent of hiring 30,000 junior advisors, the amount of note-taking. So let's talk about note taking. What's the biggest problem that these firms have with advisors taking notes? They take sloppy notes or don't do it.
Thank you. So they're solving for a problem. So it's not like those efficiencies were there to be guarded in the first place because people weren't doing the work, right?
Yeah.
Like that's the first thing. So thank you very much.
It's a pain in the ass.
It's a pain in the ass. So the biggest problem every firm's ever told me about their CRM is just getting to put in the notes or put in good notes is impossible. So now,
well, dude, you're on a call for an hour, maybe an hour and a half, and then you want to go in and put notes in. It's like.
I get it. But at the same time, it's like, don't tell me you're going to save all this time on something that wasn't being done in the first place. Like you just managed to basically take slightly less time to do a good job now, right?
But there is some truth to this idea. If one of my advisors tells me, one of my advisors in Charlotte tells me on average for like a serious client meeting, it's not an everyday meeting, but like, let's say a quarterly meeting where we're going over plan and portfolio, it's an hour conversation. It's probably 30 minutes of prep time before the conversation just to go back through what we've already been doing. And then it could be as much as an hour of note-taking, assigning tasks, sending out follow-up emails. If I can eliminate that 30 minutes beforehand and make that 5 minutes because I have an AI auto-summarizing previous meetings, and then I can turn that post-meeting from an hour to like 2 minutes because all the instructions to my coworkers are automated, that means a lot more meetings a day. That part's real.
That's real. But let's bifurcate into two different advisors. You have the advisors who were doing the right job, and the advisors who were doing the bare minimum or nothing at all. Okay, the advisors who were doing the right job just had their lives made easier. I've been using this tech; it is fantastic. I love it. The amount of time I spend.
Which provider are you using right now?
So I am actually. So right now I've just been playing with Zoom because I'm waiting for, which works really well.
Zoom's built-in AI tools.
Built-in AI tools.
Okay.
Right into it, including for phone calls.
Are you paying Zoom? Are you on the enterprise version?
I'm on it's not. It's a standard off-the-shelf business version.
Zoom Pro or whatever.
Zoom Pro, exactly.
Yeah. Okay.
Right? But that said, I am advising a AI company. That announcement hasn't come out yet. That will be in this space, and I will be once they're at a certain level, I'll be switching over to them.
You get equity?
I get equity. I get equity in every company I advise.
All right.
So you have those. So that is great, and I love that. Now you have the ones that weren't doing. Let's talk about another problem here. You also have to make sure the AI got it right, which means reviewing those meeting notes. Now, do you think the people who weren't doing the meeting notes before are reviewing the AI transcriptions? No, they're not. Right. So now you have a problem. What's that problem? What's being recorded, it may not be accurate. What's being transcribed may not be relevant because we were also talking about your dog's birthday. Or what might be the action items might be wrong.
Well, that's the most dangerous part.
That's exactly
If you are not reviewing the action items the AI is creating for your client service associate, or if trades are being done that should not be done, like it still requires human oversight because you can't fire your AI. Like you're going to have to fire a person if they blow it.
Accuracy is vital in this space, vital. And the AI is not there yet because there's too much contextual stuff going on there and any number of things can go wrong.
Are you bullish overall that within 3 years, every RIA will be paying somebody for AI note-taking services?
Yes, because I think you'd be mad to do anything but.
Okay, so
No.
we're skeptical of what people are saying is the output right now, but we're in agreement that this is going to be
100% base
a
core
must
functionality.
category.
Now, here's the other thing that's interesting. Notice how they said they're doing summaries. Notice how they didn't say they're doing transcriptions. Right?
Say more. Transcriptions like already
full
exist. And
transcription
it's
of the meeting, right? Like they're basically doing a
This
summary.
call's being recorded for customer
Yeah, well,
quality.
but they could. So there's already transcription services that have been around for years with using humans and technology hybrid. But here's the real reason. So I was talking to a colleague of mine in the AI space, and they had actually pitched that they could do this to a major wirehouse, and the compliance department's like, absolutely not. They don't want.
Which part of it don't they want?
They don't want the transcription. Because let's
They can
face
be
it,
held liable for
bingo, every wirehouse knows that their advisors say and do things that they shouldn't be doing, and no one wants a record of that.
Yeah.
In fact, there's a lawyer I know in Toronto who defends advisors when they get sued, and ask her opinion of transcription. Don't do it.
It's like sitting in a meeting and somebody's wearing a wire.
Yeah.
Exactly.
We smash our phones after every meeting, actually.
We only talk on burner phones.
So was snap gone. Anyway, so the funny thing about the rest of this conversation was effectively, look, they loved all the intelligence they could garner from this. Like, what are people talking about? What are the topics that matter to clients? All this other stuff, but they didn't like the transcription. So they basically said, is there any way we could just like analyze that and then get rid of the recording? And I'm just like, did you just admit to a crime? You're like, let's just burn the records.
It's so funny because I could see this going full circle where it starts out like, oh my God, this is making my advisors more efficient.
We gotta get rid of this.
After
No. 3 years from now, it's a new SEC rule. You must maintain the transcription and AI summary of every client phone call, and it becomes a new requirement.
If it's that easy
totally
to do, why not? Like it's so yeah.
What's the argument for not doing that?
For not,
like from the government's point of view, why would a reasonable person who's doing the right thing say, no, we're not going to comply with that?
Look, I think clients,
privacy of clients.
Privacy of clients. I think the privacy of clients is, I mean, two things. First off, let's be clear. When it comes to using open protocols, you're putting stuff into an open system. You should not be putting personal information in there. You already had, sorry, this gentleman's name from artificial intelligence risk came in, and he talked about creating layers of security over that. So that's the first thing. Like, how are you policing the personal information that's going in there? Don't put it in there. Second thing is basically the privacy in general. You forget the tech aspect of this. If I don't want myself recorded, I have that right.
Yeah.
Right. So.
Oh, I would take it a step further. The easiest thing the industry can say is no fucking way. This is like an attorney-client level of privacy. These people are talking about their personal lives.
Yep.
You can't force me to make them agree to a recording.
Yep.
That's like they don't do that with lawyers and murderers.
Agreed. So there's an entire, I mean, this is almost a Big Brother-esque level conversation. Yeah. Right. So there's a lot. This is something to unpack from an ethical standpoint. Forget a compliance standpoint.
I would just say the long march of technology, like what ends up happening is in every area away from wealth tech, we do end up over time giving up more of our privacy in exchange for more convenience.
Well, we don't know where it's gonna go, but it's coming. No doubt.
I mean, look, there's entire massive, basically big tech companies built on us giving away our privacy. Look at Google's completely built on us giving away our privacy. Yeah. But we receive something of value. Now, whether or not that trade is fair or not, that's almost something.
Jason, you've been an incredible guest. We've been looking forward to this for a long time, and I want to tell the advisors who are watching this where they can follow you on a more regular. We'll have you back, but we're not going to have you back next week. So I want to tell people where they can get your stuff on a regular basis. I know you have a blog, you have a podcast. Give us all the details.
Yeah, so all my content goes through jasonpereira.ca. Hopefully,
jasonpereira.ca.
Yep.
He is a secret Canadian. Again, very important to
I have a CFP in the U.S. also. I play in both neighborhoods. Okay. And then, so my podcast is FinTech Impact. That's like 300.
FinTech Impact.
Yep.
I love it.
Yep.
How many episodes are you doing? Are you once a week?
Once a week. I'm at 300. I've already recorded 350 something. About 340 have been released or something. So yeah.
Okay, and you're mostly interviewing from what I've heard, you're mostly interviewing fintech founders who are in the advisory space or want to be.
That's it. Just letting them tell their story, letting advisors discover what's out there. So I often tell people, it's like, they'll come to me asking about tech. I'm like, well, you want to look at these solutions, and here's my interview. Hear from them.
Yeah, dude, I think you do an outstanding job, and thank you so much for letting us know how things are going from your perspective. We definitely appreciate it. And for anyone watching, make sure you follow Jason's stuff. Are you Twitter, LinkedIn? Where's
Twitter mainly. LinkedIn and Twitter. Twitter's where I have my fights.
Twitter?
Jason Pereira.
Follow Jason Pereira, guys. Thank you so much for listening. Thank you so much for watching. And please, there's a link in the description. That's how you could sign up for the Unlock, and you're going to get a lot of extra stuff by being on our distribution list. So make sure you go ahead and do that as well. We'll see you next month.